Hello, everyone, and welcome to our October investment market update. Today, I'm delighted to welcome Wayne Bishop, who is the Chief Executive Officer of King Shaxson. Hi, Wayne, how are you?
I'm really well, thank you. Good morning, Michael.
Good, thanks for joining us. I understand you're off on holiday later today.
I am. I'm looking forward to a nice long break. It's been a long time since I had a holiday, as I was explaining earlier, having gone through the adoption process. We finally have a passport. So, yeah, we're off to Turkey for the half-term holidays and looking forward to it.
Good. Well, look, thank you for coming on today. And what we'll do is try not to keep you too long. But obviously, when we've had a conversation, we've talked generically about what's going on in the world. And I think it's really useful at this point in the year just to take stock on what's sort of happened in the last 9 months. Think a little bit about where we are with the most recent inflation figures and what that means really over the coming sort of 6 to 12 months. So is it all right if I just sort of ask you your thoughts on things? So what's kind of gone on with inflation? My understanding is headline inflation has remained static in September. But actually what we've seen is the increase in cost of gas and oil has been offset by a drop in cost of goods. So there seems to be a bit of positivity around that.
I would say so, because it's interesting. If you remember, for a long time, people talk about the difference between core inflation, i.e., the things that really eat into our day to day and are very inflationary. Those things that are variable, and gas and oil prices, of course, go up and down depending on events. And of course, recent events in the Middle East have suddenly sent gas and oil back up again. So it's nice to see that the real hardcore matters are still really coming down, whilst we've only just had some, hopefully, and I do say hopefully, short-term volatility in the oil and gas price. So, yes, this is good news. And I think with the general sort of feeling that, one, there's no more catalyst for really strong inflation. I know pay is still working its way through the system, but really now we're beginning to see some of the tightening, some of the measures the Bank of England took back in the beginning of 2002, beginning to impact and beginning to get a grip with inflation. And that's certainly been the words we've been hearing from the central banks as well.
Great. I think what was also quite interesting is that as of next month, with the price cap reducing, that they also believe there's going to be a big chunk of inflation reducing again. That's almost a guarantee. Is that right?
I would say so, definitely. And I think now, I think when a shock happens, sometimes we think that sudden reverberation and that sudden surge in oil and gas prices that we saw really pummeling through the market just really the first half of 2022, that shock has slowed down and all the future effects are less and less. But of course, that was a huge contributor to inflation, because that wasn't just our electricity bills and our gas bills, which were painful enough for many of us, but that was also how it affected industry, how it affected your bakers, everything. Everybody was affected by it. So the fact that, one, we're seeing a little bit more control in the price, the fact that we as households are going to see our bills come down, I see as a good thing. Ironically, obviously, as you know, we have a vested interest in renewable energy. And last night, I was just looking at the dials. Half of our energy last night on a nice windy night was wind. And of course,
Incredible.
the price of wind has never really gone up anyway. So I think there's definitely that capacity for those prices to come down. In fact, I'm one of those advocates who think they could come down even further. So I think we've got better news on that front. Of course, we have to keep one eye on the oil price, because that is perhaps the other variable out there. But that's getting less and less significant over time as well. But of course, I agree with you. I think you're right. I think the background story for inflation is still continuing to improve.
So that sort of allows Rishi Sunak to say that he's halved inflation in 12 months with no with no tools at his disposal. He's waved a magic wand. But with that coming down on the gas and oil, that's really because we're on a rolling 12-month figure, aren't we, for inflation? And so the spike we saw this time last year with Liz and Kwasi Kwarteng and all of the stuff that was going on around gas and oil prices then, that's why we're going to see this sort of 1.2% drop next month. So that sort of leads me on to my next question and thoughts around interest rates and what's happening there, because if we look back to sort of 2007-8, the impact of interest rates going up were felt very quickly within the UK economy and by us as individuals. And that's because of the way the mortgage market was working at the time, where a lot of people were majoritively on variable rates or tracker rate mortgages. Obviously, roll forward 10 to 15 years, the vast majority of people have been on fixed rate mortgages and cheaper fixed rate mortgages. And so if we understand that putting interest rates up is about trying to squeeze people's capacity to spend, which then effectively takes the heat out of the economy and inflation comes down, what's the general view on interest rates? Because we've sort of seen a lag more probably than what we did previously of interest rates actually taking hold on people's capacity to spend. We've certainly seen it as providing mortgages for people that, you know, they're now starting to come out on 2 years and 5 year fixes, and they're sort of seeing £700, maybe even £800 a month more on their interest. But that hasn't been the case for the last 12, 18 months. So are we at the peak of interest rates, do you think?
My view certainly is we are, and I think we had a few things. One, we start with credibility. I think the language of the central banks might be slower to change, but we have certainly seen that with the actions. They're beginning to hold fire now. They're beginning to pause. We're not seeing those automatic rate rises, and that's happened both in the US and in the UK. And we expect that to happen in Europe, sort of coming up fairly soon as well. They are just a little bit behind, but that is, I believe, the actions are very important there. The market is still a little bit unsure because, one, I think the market got it wrong when they started raising rates because they kept going. Then we've used this mantra of higher for longer. And a lot of the market uses two words. They use Table Mountain and Matterhorn. What do they mean by that? Well, the Table Mountain is it goes up like Table Mountain in Cape Town, and it goes along for a long time before it goes down again. And so a lot of people think that they won't be cutting rates particularly soon. Whereas before we've been used to the old Matterhorn where you go up like that and then straight down like that. Now, most people are following the Table Mountain logic. But I think the fact that these fixed rate mortgages that you mentioned are quite a significant difference to 10 years ago when we, or 8 to 10 years ago when we last had these problems. And back then we were in the financial crisis. This time it's been much more of a classic economic crisis. Now, I think the J curve, as we call it, when interest rates begin to bite, is more delayed, but when it bites, does it bite a lot harder? Because you were used to mortgage going up £50 to £100 maybe and being ratcheted up bit by bit. You could adjust. A lot of people are suddenly getting the shock of their life when suddenly they've got to find £700-800 a month more, on top of higher electricity bills, on top of higher finance bills. So that is definitely, I think, really beginning to hit the economy and will continue to do so in a kind of shockwave over the next 2 to 3 years. So although the market is expecting higher for longer, I actually think there is perhaps more scope for interest rates to start to slightly fall. Not massively. I don't think we're going back to 0 or even to 3%, but I think that there is potential for interest rates to start to fall. So certainly on how that impacts the economy, I think that's also very important because a lot of infrastructure assets, a lot of REITs, for example, where there's two parts of the story. The one part is obviously owning the asset, watching either the wind turn if it's a wind asset or people pay rent if it's a REIT, come in, and obviously your cost of finance is the other side. Most of these people had their cost of finances fairly well structured, so they've seen little rises in their cost of finance, but nothing too serious. But the other half of the story, which is quite a contributor to their business, is the new developments, the new properties, the new infrastructure assets. That has been killed because obviously new project finance is very expensive at the moment. So basically, we've seen a dearth of new building projects, which is why we're seeing, horrendous construction numbers and horrendous construction details because. And don't forget, this does lag a little bit. So the projects happening now were probably thought up 2 or 3 years ago. So before all of this, but we're seeing a dearth in the pipeline. So that is where I think you've got to be a little bit more forward thinking, and especially for central bankers. They're not just thinking about the inflation numbers that next come out, because obviously people were a little bit disappointed with the numbers yesterday. But actually, as you said, when you actually drilled down, you realised it was the core number was still coming off. But actually, what you were realising is that actually we are endangering some of the future. And I think the mantra and the words are staying the same because central banks change their language very slowly in a very considered manner. But I think what we're seeing with the actions is already one story. And I think market expectations might start to shift earlier next year.
Great. Because, I mean, when we look back at what's happened with generally portfolio performance over the last 12, 18 months, we've gone from a really big rise just off the back of COVID to seeing obviously quite a big fall back in a lot of portfolios. And then, with certainly more cautious portfolios, there's been more impact on those than what we would normally expect in this sort of scenario, just because of the way interest rates have risen and the sort of the impact that's had. Now, that then plays into what you've just spoken about, which is where money is no longer in sort of infrastructure projects, and they're sort of flowing into other assets that are safe. So really, it's about seeing those interest rates hopefully coming back down. And as you pointed out, central banks need to think about the future, and money's only going to flow back into those infrastructure projects if borrowing becomes a bit cheaper and interest rates become a bit cheaper. And I would say that that's probably the case across the entire market, isn't it? That, if you look at it, that investment is not going into companies or forward investment because of the costs associated with the debt that would be required to do so. So as interest rates start to come back down, that breeds confidence in the market to say, actually, now we can go and have those infrastructure projects, or companies will go, right, we're now going to go and buy another company, or we're going to invest in this, or we're going to invest in that. Is that a fair assessment, that hopefully as interest rates come down, we might start to see growth come back to the markets?
I think that there is a degree of a fair assessment there. I would agree with you. I think there's probably another variable that we have never had to contend with before. So variable number one, and I think this is something that I think we have missed in the market, because no one thought about it, is, as you remember, back in the financial crisis, the central bank started printing money.
Yep.
And the US Fed balance sheet, i.e., that's how much money was saying the US economy, went from $2 trillion to $6 trillion. But of course, it didn't cause inflation because the banking system was crippled at the time. So you may have had high supply, but you didn't have velocity. And any old student of economics will know that did make inflation. Now, when we had COVID, the Fed balance sheet then was 4.8 trillion, and it went to 9 trillion in America. The UK balance sheet was 1.6 trillion, the European balance sheet about 7.2 trillion. Now, I say that to be too technical, but actually, in the last year, the US have also reduced their balance sheet from 9 trillion to 8 trillion. So they've taken $1 trillion out of the economy, not with interest rates and the price of money, but actually just sucking it out of the economy, taking it out of the economy. And this means that some of that wild money that was leading to excessive valuations in certain areas, floating around in the economy, has been taken out. And I think this has had quite a big impact on the market, because I would say a lot of those trillions weren't hitting necessarily the street. They were hitting financial markets a little bit.
Right.
And now it was not so much where sensible investors are. So, but if you remember, in America, they had these companies raising 10 billion. They were referred to as an SPAC, or a SPAC, a special acquisition vehicle, and they were raising 10 billion to. And there was a famous story of a guy pushing an electric car down a hill because it didn't work, and all these kinds of companies. And of course, they've all gone to zero. But there was too much money. We had a market driven by something called FOMO, fear of missing out. Now, that was really only at the wild west end of the market. As I said, that probably didn't impact portfolios as much or too much, just really if you had some very sort of high risk areas. But the fact of the matter is, and it wasn't just in ESG or impact, it was across everywhere. In fact, a lot of it was in fintech or technology. Right. Now, but we have drained $1 trillion out of the US, and they expect more draining. That's going to happen. We haven't started yet in Europe or the UK, but I think everybody wants to do the same thing. So in other words, as well as driving down inflation, people also want to bring in some of these excessive balance sheets. So as we normalize on interest rates, we will see a degree of normality, and we will see capital discipline come back in. But a lot of people have had to really dust off the old textbooks and go back to really good capital discipline. So I think on infrastructure, yes, money will flow back, because if you get 6% in the bank, or you can get in T-bills between 5 and 6% at the moment, why would you invest in infrastructure? Absolutely not, because the cash is much lower risk. But when you start taking inflationary aspects into account, you can either look at index-linked bonds, which are very expensive and don't yield a lot, or people will look at things like infrastructure, because it's not just about your return today. Of course, it's people also thinking about the index linking. So I think, yes, infrastructure and property are becoming more attractive. And I think once interest rates come down, some of those projects that have been, that pipeline needs to happen, because we need the infrastructure desperately. I mean, the grids, the build out there, that needs to happen. A lot of sort of social building needs to happen. So that infrastructure is still going to happen anyway, and I think it is going to happen. But those projects will start to come back online. We need the property desperately, as you know, across the country. There is a chronic property shortage, and I think builders who have had to contend with supply chain issues and labour issues, as well as obviously the fact that the costs of projects have been made uneconomic, those ones will come back. I think so. So we're going to start to see some projects come back, but it will come back perhaps at a slightly more muted and a much more disciplined pace. But you'll feel a lot more comfortable with what's coming back because the capital discipline has now become a lot harder and a lot firmer.
Yeah, the way I've sort of thought about this is that ever since the 2008 credit crisis and the financial crash, we've been in uncharted territory in some respects, and we've been, I guess, bucking traditional economic theory. And it feels like with the raising in interest rates to where we are and what's been going on with some of the markets is that we've almost had a bit of a reset in 2022. And whilst that's a painful thing to go through, actually, hopefully the positive that comes out of it is that we're now in more charted waters rather than uncharted waters in terms of how we come out of this and what the future might hold. Is that kind of a good overview of it, or do you sort of think there's more to it than that?
Yes, I do. I think you're right, and I think you saw the classic examples. I mean, Wall Street, they floated up, and it went from 70 billion down to 50 billion, which are just astronomical numbers for a company, and hasn't been a rip-roaring success since it floated. And that was only 10% of one of our countries. It's a British company, one of probably the greatest success stories of the British economy in terms of the chips that go in phones and the high tech in designing this high tech. So that to me has been a fantastic example of, if this had happened maybe a year or two ago, the price would have been much higher, the follow through would have been much more aggressive because there was money that needed deployed. Now we are back to what I call fundamental economics. People aren't getting away with it. There were 2 or 3 flotations around the same time. They were all having the same problem. Basically, that wild money isn't there anymore. So that has sort of led to some very negative headlines about the markets, maybe, that aren't really true. We are just back to some very firm discipline. And I think that will impact everything from fixed income to every market, where I think quality will have to matter. And that means when you look at growth, you've got to think very hard, what is real growth? Because what has happened obviously in the markets, and I think we're beginning to start to see this sort of show through, and in fact, even a little bit last night, there has obviously been some genuine growth where people are going into a new product, that new product is taken on and people are moving. And then there's been hyped growth, if you like, or consumption-led growth. Now, consumption-led growth, I think, is obviously under a lot of pressure. Some of the superstars last year, like holidays, for example. And I know I joked that I'm off on holiday, but I think a lot of people are worrying about how are they going to afford next year's holiday, which perhaps wasn't the case when their mortgage was a lot cheaper. And these kinds of sectors, and that last hurrah, a lot of comments now that all the COVID savings have been spent. Kind of now means that I think consumption economics is going to be perhaps a little bit under threat. People will probably eat out less. People will be doing a lot less of the classic consumption. So I think the capital discipline will say, so what is genuine growth? I.e., what is the technology of tomorrow? What is going to be happening anyway because we've got to replace old things or new things, which again talks a little bit about some of the quality infrastructure projects, but also some of the technologies of tomorrow that really matter. So we could talk about renewable energy that has been struggling because it's suddenly had to grow very fast. And it's hit all kinds of issues because suddenly the pipeline's gone mad because everybody suddenly wants renewable energy. There's big projects in America, big projects in the Far East. But they've got to build up their capacity. They've got to build plants. They've got to suddenly spend money. And they've had to spend a lot of money feeding into this growth because people don't necessarily want it for environmental reasons now. They want it for security reasons. And as I said, when half your energy is wind, I don't understand why my bill's so high. because, as I said, wind hasn't got more expensive. Those are other structural issues that people need to think about. But the desire for growth, I think, is going to be very different as well. So it's not going to be perhaps as easy as people used to think it is. I think people are going to have to search out that genuine growth story in and factor in perhaps a more variable or harder discipline on the availability of cash, because the scrutiny from the market is going to be a lot harder as well.
Okay, so what does that sort of mean for 2024? What do you think? Can we be optimistic about 2024? Cautiously optimistic, based on where we sit right now?
Yes, I think actually the optimism from my point of view comes from probably three or four things. One, we've been through this huge shock of interest rates going up substantially in percentage terms, if you think about it from what it has been. And we've recovered from the shock that money is no longer easy. It's actually now requires a lot more thought, discipline, and it will get harder as markets trade it back. We're still got obviously geopolitical events going on, and there's plenty to worry about geopolitically, if I'm honest to you, over the next year. But also at the same time, what we've learned, and we learned this very much during Trump's first time in power, is it doesn't matter what the government does, the world of business gets on with it anyway. And I think in terms of the world business, I think there is a lot to be got on with. So I think as far as markets go, I think people are getting their confidence back. I think the run into cash is now people are going to be looking, well, this return might not be here next year. Where else should I go for my returns? And I think that will favour fixed income. That will favour not so much fixed income. That will favour as infrastructure and equity investments. Why am I perhaps less positive about fixed income when fixed income interest rates are falling? Well, interest rates, I think, will be falling. But at the same time, a lot of money went into fixed income last year. And if you like, that huge amount of extra demand, because we did like everyone else, and unfortunately, like most people, we got hit by Liz Truss on the way, but we recovered and people carried on a bit, was that they moved into this because suddenly it was interesting again. Yields at 4, 5, 6%, they're interesting. But that was hit with huge amount of supply because government deficits didn't go down and corporate debt issuance didn't go down. Now, this year, government deficits are still high, corporate issuance is still high, but there's no surge in demand. So you might find with fixed income something called the yield curve steepening, which has been happening a little bit already and might continue to happen, is that actually fixed income, if you're in short durations, you might be okay, but longer durations, you might find that there's going to be perhaps buyer strikes or people will prefer to keep it short for the time being. So you might find there might be some differences in fixed income. So that's why perhaps I'm saying people might want something that's got a bit more of an inflation hedge for the future, is perhaps a little bit more based on global growth. Global growth is still happening. We have a higher exposure to India where we are still seeing that growth happen. And India, to me, is China too, in one sense, same size of population, 20 years behind. Obviously, they have got very big differences. India is a huge democracy. China isn't necessarily a democracy. India is perhaps less well organized, but India is also more dynamic in many other ways. So we've got the rise of India. I mean, they've just sort of got to the same size as the British economy, and I think they've got a long way to go. We've got other parts of the world rising. We've got whole new technologies rising around batteries, around energy storage, around electrification, around communications, around medtech that are still rising, and people's standards and expectations are still getting stronger. COVID has made medical science more interesting again. And of course, obviously, there's constant worries about what comes next. So there's still an awful lot of growth going to happen, I think, and a lot of exciting things happening. But it won't be so classical, I think. I think it will still be slightly different. So the typical thing we expect and how we've positioned ourselves is smaller companies should do better, medium-sized companies should do better, because as people get confident in the market, they move from where they've jumped into the very big stocks and they'll move into the other stocks as well. And so we expect to see the market rotate a little bit. We expect to see a little bit more search for genuine growth, and perhaps a little bit less reliant on, as I said, us going out and spending more money when interest rates come down, or we get a tax rebate, which I don't think will happen because I think government finances are still very tight. We'll still see that kind of behaviour.
Absolutely. I mean, I think it's always interesting, isn't it, how the markets always will try and find an opportunity out of any circumstance that comes their way. And whilst obviously the markets have not had a great time of recent late, they're preparing them. So it feels like we're in a preparing stage where we're, I've used the term a couple of times, bobbing along. We're sort of just treading water at the moment, waiting for things to turn a little, and just hope that if that's the case, then 2024 can be a more positive year. I mean, that's obviously assuming there are no other out of left field events that come our way. You can never tell. But I think if we look back over the last 3 years, we've had successive individual events that have come along that have had an impact, and collectively they've created this situation we're in. One or two of those, perhaps in isolation, we might have been able to have dealt with, but it's just been continuous. And so hopefully now we're in a position where that's all been relatively priced in. And as you said, if we're now starting to think more longer term, we've dealt with the short term bit, which is let's all go into safe, we get a bit more here in bonds, we can get a bit more here in other areas, come out of those other funds like infrastructure. But if we're now sitting at the point thinking interest rates are peaking, then where are investors going to get their returns now? And paraphrasing what you've said, they're going to have to start looking back at these opportunities. And then that's going to therefore be money flowing back into those kind of projects and those areas. In turn, with interest rates coming down, means that hopefully we start to see the trickle down effect from the larger businesses, as you said, now moving back down into the sort of mid caps. And that's hopefully where we start to see some real growth coming through.
Yeah, I think actually if we put some numbers on it, because I think I always find this quite important. I will just quickly share one slide. If
Brilliant.
I've got it here. I'm sorry it's numbers, but it's just, I think, just sort of highlight some of the things we've been saying, some of the factors of the short term that I think have affected us. But US large caps since the 30th of December 2020, which I think is where markets began to where things are trends. The large US stocks are up 35.96%. The mid and small cap stocks up 0.82%. In the UK, the top 100 up 28%, but the mid caps down 8 points, down over 8%. AIM, which is obviously the ultimate high risk market, I've only put this in for effect rather than actually just that we'd have seriously large amounts of money there, but down 37%. I think that actually sort of highlights how the real focus of equities during this time of uncertainty and perhaps just mass movement of money has been focused on the large caps for the time being. And the smaller, more dynamic companies have just been sort of left out in the cold. This happened actually after 2008 as well. I remember back then, 2009, 2010, 2011 were rather dull. It felt because the whole world was recovering from one crisis and the money moved that way. And then slowly, as the money trickles and people move along, as you build confidence, and I think markets like to sort of see, you don't need a crystal ball, but you need to sort of feel confident, and you need to feel that your cost of capital isn't going to suddenly go surging ahead again. And banks need to feel confident that they can lend at decent rates and actually also, one, get their money back, but two, that they can hedge forward correctly without too much expense. So I think because we're now getting back to that kind of confidence and that kind of certainty, I think the markets are now ready for perhaps some of that rollout to happen that we've been talking about.
Fantastic. So all in all, we're hoping for a better 2024.
Definitely.
Superb. All right. Well, look, Wayne, I'm going to leave it there. Thank you ever so much for coming on today. We'll let you crack on with your packing if you haven't done so already. And thank you everyone for tuning in, and come and join us again next month for our next update. Hope to see you all soon. Thanks for coming.